Welcome to the Clive Owen LLP Budget Seminar based on the Chancellor's first autumn statement on the 22nd of November 2017. We are delighted to welcome you today. I'm Rosemary Anderson, a tax partner at our York office, and I'm going to start the presentation by talking about personal tax and business tax. I will then introduce Nicola Bellaby, a tax partner from our Durham office, to talk about employment taxes and sundry matters. My presentation will recap some numbers from the budget that we already knew about and the amendments from the budget itself. Firstly, I'd like to start with personal allowances. For the tax year 17-18, we're already aware that the personal allowance was £11,500. That is going up next year to £11,850. Now, the increase is in line with the government's proposal of making the personal allowance £12,500 by the end of the Parliament. For those who receive income in excess of £100,000, this personal allowance is reduced by £1 for every £2 in excess of that £100,000. The £100,000 has been in place since 2010-2011 tax year and hasn't seen any increases. However, as stated, the personal allowance is going up annually. Tax bands. The government has increased the tax bands in line with RPI and a little bit more as promised throughout their sitting. For the 17-18 tax year, the basic rate band is £33,500. Any income over £150,000 is taxed at an additional rate. The basic rate band is increasing for 2018-19 to £34,500. However, the additional rate is staying at income above £150,000. Although the government is set on increasing the basic rate band, it seems fixed on keeping the additional rate band at £150,000. It doesn't look as if there's a line for an increase in that amount in the near future. Dividend taxes. 2 years ago, the government completely changed the strategy on how they were going to tax the dividend allowance. Dividends are now subject to an allowance of £5,000 at which 0% is being paid. In excess of this £5,000, anybody within the basic rate tax band pays 7.5% on their dividends. Anybody in the higher rate tax band pays 32.5% on their dividends. And anybody paying additional rate tax is taxed at 38.1% on dividend income. That has been in place for a couple of years now. Previously announced, the government did say this was going to change from 2018, whereby the dividend allowance is actually going to be reduced from the £5,000 down to £2,000. This results in the following rises in the amount paid by people in the various bands. The government has confirmed, however, that 80% of general investors will continue to pay nothing on their dividend income that they received. They are relying on the fact that people either have a small amount of dividend income or they have significant portfolios. The people with the portfolios will be caught by having to pay tax on this additional £3,000 with the reduction from the £5,000 to the £2,000 in the dividend allowance. But most people will continue to pay nothing on the dividends that they receive. In addition to the dividend allowance, there is a savings allowance available to people. Now, this is a personal savings allowance whereby basic rate taxpayers are allowed to receive £1,000 in interest at which they don't pay any tax. Higher rate taxpayers are allowed to receive £500 with nil rate tax. additional rate taxpayers are not allowed to receive anything untaxed, unfortunately. In addition to the personal savings allowance, there is a savings band. Now, the saving band is different from the personal savings allowance. This band is basically available to people with savings, with income, non-savings income in excess of the basic rate band of 11,500 personal allowance. If their income is lower than that, they are allowed to have £5,000 of tax on £5,000 on savings completely tax-free. If their income exceeds the personal allowance, for every pound it exceeds the personal allowance, this saving band is reduced. Now, this band is at 5,000, and we were expecting, with a reduction in the dividend from 5,000 to 2,000 allowance, we were expecting the savings band to decrease also. However, the government have kept it at the 5,000. This means when we look at how much somebody can take from a company tax-free, in 17-18 tax year, they can have a salary of £8,500, they can have dividend income of £8,000 and interest of £6,000 tax-free. Now, the salary of £8,500 keeps them below having to pay any NIC. The dividend of £8,000 is basically the £5,000 tax-free, and then the additional £3,000 taking their salary and the dividend up to the 11.5 personal allowance. They can, in addition to this, receive £1,000 interest on their personal savings allowance and the £5,000 saving band, giving them £22,500. Giving that a direct comparison to 18-19 and ignoring the fact the personal allowance has gone up, with the reduction in the dividend allowance, they would only be able to receive £19,500 tax-free. However, £19,500 tax-free still gives a married couple running a business together £39,000 they can withdraw out of the company. Now, looking at that in perspective, how can they take £6,000 of interest out? Well, they can do that by loaning some money to the company. If they had the money in a personal bank account, the likelihood they could be earning probably about 0.75%, 0.75% on money in a bank. However, if they loaned some money into the company, which would be unsecured, they could receive a significantly enhanced rate, probably in the region of 6% to 7%, meaning that they would only have to lend in about £100,000 to receive such an income. However, they'd need nearly 10 times that to receive that level of income if they had that in personal savings. One amendment that came forth in the budget was the marriage allowance. If neither married person in a marriage paid tax above the basic rate, then 10% of the personal allowance could be transferred between the spouses. In the past, an election had to be made during the tax year in which it was paid. This caused all sorts of problems when there was the unfortunate circumstance of one of the spouses dying during the year. However, the government has amended the legislation and it's now possible to transfer the marriage allowance and backdate it for 4 years from which you're entitled to that. So that gives a lot of scope for executors to come in and deal with the circumstance when somebody dies, unfortunately, during a year, particularly early on in a year. So that's a welcome change that we have seen in the budget. Rental room relief was mentioned in the budget. However, nothing was changed from that at the moment, but the government specified that they would be looking at this, having a consultation for it, because they felt it was currently under abuse. At the moment, people can rent a room out in their house for a lodger, or for whoever, and receive £7,500 tax-free during the year. Certain conditions have to be met for people to qualify for that. However, basically, you could receive £7,500 of income tax-free without having to pay any tax at all on that for renting a room out. However, the government feel that with the growth of the Airbnb and overnight, people staying overnight as semi-lodgers, this has become abused, and they believe people are taking advantage of rent-a-room relief where this shouldn't be. So they have announced this will be under consultation. We don't know which way this is going to go. We don't know whether the legislation is going to be changed so that it encompasses Airbnb arrangements, or whether it's going to be complete change of the legislation and a cut down on this, meaning that it can only be available where people are actually renting a room out to genuine bona fide lodgers. We'll have to wait to see what comes from that. That's really a summary of the personal tax changes and a refresher on what's been coming forth for personal tax. Now we're going to look at business tax and the changes and things that have been kept the same announced in the budget. I'm sure you'll all been aware that making tax digital for businesses is looming on the horizon. And from April 2019, if a business is registered for VAT, they will have to comply with making tax digital. This means they will have to provide quarterly records, digital records to the revenue, and it's all a bit of a headache for general businesses at the moment. Businesses includes sole traders, landlords, and self-employed. So anybody who receives income or is registered for VAT and is above turnover for the VAT threshold, they will have to comply with this. Now, Nicola is going to cover something further on regarding the VAT threshold. We were partly expecting this to be reduced during the budget, but we believe that this was kept at the level it is to tie in with making tax digital for businesses. We did feel this may be reduced. Having done that, it would mean that a lot more businesses would have fallen within making tax digital. And the government has always said that it wants to make sure that they have a solid system that works well before they start tinkering with it. And we believe that this is partly why the VAT registration wasn't decreased. However, like I said, Nicola will cover that in detail a bit further on. The rate of corporation tax. Now, it's been at 19% for both small and large companies for a couple of years now. The companies were brought together. Tax rates in the past have been as high as 32.5%, if not higher. But it's all been brought in line and is now down at 19%. This does make us an incredibly competitive country for people to come and bring their business into the UK. The government believes that the reduction in the corporation tax rate to 19% from 20% as it was previously has significantly boosted the coffers of the government from the collection of corporation tax. With that in mind, the government are looking to reduce the corporation tax rate to 17% from April 2020, and there has been no announcement to suggest that this is going to be changed. Northern Ireland rate may be devolved in the future, but that is part of the general devolution in Northern Ireland. That's not covered here. The decrease in rate to 17%, it's hopeful that there's going to be a significant increase in the corporation tax that is generated in the collection of corporation tax from that, due to companies wanting to establish themselves here, wanting to be part of a British economy that has such a low tax rate. NIC. Now, we were expecting changes from 2018 to NIC. However, in the budget last summer, the government made an announcement that they had to quickly withdraw from, that they were going to try and equalise Class 4 and Class 1 NIC, and it caused uproar within businesses. They have now decided to defer changes that were going to be in place, where Class 2 NIC was going to be abolished, meaning Class 4 will be the way that state benefits are generated. Now, they went to great pains to state that this is now going to be deferred until April 2019. We don't understand why this has been deferred. We are thinking that it may be that they may try and increase Class 4 from April 18 in the spring statement that's going to be coming on, but we don't actually understand why this has been deferred. However, it does give people a chance to get a few more ducks in a row for the administration of this. One thing the government is very keen on, and one of the reasons why they have reduced the corporation tax rate, is to make sure that Britain is a place where a significant amount of research and development is undertaken. Now, large companies and smaller companies actually claim their R&D tax credits in a different way. The way the small companies claim the rate hasn't been altered. However, larger companies claim through a mechanism called above the line, whereby the government provides 11% relief on expenditure. This relief has actually increased to 12%, meaning that larger companies are going to have even greater tax benefits from undertaking R&D. So not only is their corporation tax rate going to fall by 2% from 2020, but the R&D relief that they can claim is actually going to be increased by 1%, giving them a significant increase in their profits from which they don't have to pay tax. That's again very welcome for the larger corporations which undertake the vast majority of the R&D within the UK. One change that was announced in the budget was in connection with indexation allowance for companies. I'm sure many of you will be aware that indexation only applies to companies. Individuals are not entitled to claim indexation allowance on the sale of capital goods. Companies are. Individuals have the benefit of being able to claim entrepreneurs relief and various other reliefs available when goods of a capital nature are sold. However, companies can only claim indexation allowance. The Revenue have said now that they are going to freeze indexation allowance. Now, indexation allowance has basically been available if you've owned an asset since 1982 up until now. Basically, you can claim an additional 247% as your indexation on that. So if an asset cost 100,000 in 1982 and you sell it now, you can have an additional cost allowance against your proceeds of £247. So the £100 you paid for it originally, you can have an additional £247, meaning that you have a cost of £347 you can deduct from your proceeds. So if you had sale proceeds of 500, you can have £153 that you pay profit on, as opposed to £400 if you just were allowed the cost. Now that is going to freeze, and it's basically going to stay at 247% going forward, but it's still going to be there. It hasn't been withdrawn. When the Revenue withdrew the indexation allowance for individuals, it was withdrawn completely. Nothing was frozen, but it is actually frozen. Indexation allowance is available when capital assets are sold, but it's just going to be frozen at December 17. Now, the final slide within business taxes is regarding IR35. I'm sure many of you will be shuddering at hearing IR35, as it was a bit of a sledgehammer to crack a nut that the Revenue think, because it's the legislation's there, that they need to keep drilling on and on at it. Back in April 17, there was a big clampdown whereby the public sector had to prove that any intermediaries they took on were actually genuine self-employed. If they couldn't, then they had to put them on their payroll. Now, the government has announced that it's going to undertake a consultation to do exactly the same in the private sector. Yet again, we don't know what this is going to entail, and we are actually struggling to see how they're going to implement this overly successfully. But along with many things that the government do, we're going to wait and see. Now, that concludes the business tax presentation, and I'd like to pass you back on to my colleague Nicola to talk about our section.
Thanks, Rosemary. Right, so first of all, as I said earlier, I'll be speaking about employment taxes first, then moving on to capital taxes and some miscellaneous items towards the end. So for employment taxes, we're going to start with termination payments. There's been no changes to the 30,000 exemption from tax that many of you will already know about, but there's been a bit of a consultation that the old rules incentivise employers to manipulate the rules. So the government's trying to stop that. They've brought payments in lieu of notice where they're contractual, as well as the ones that are non-contractual. They're both now taxable. The non-contractual didn't used to be taxable. And they've also brought in a Class 1A charge, that's national insurance, on any termination payment over 30,000 as well. But that's from April 2019, so there might be some planning opportunities there. Moving on then, car benefits. These seem to go up every single year, and a strange anomaly this year is that the smallest emission cars, those figures down the side are carbon dioxide emissions of cars, and these are the percentages that are applied to the list price when new. So that top line relates to electric cars, and we're quite surprised that that's going up as quickly as it is. So 2018-19, 13% of the list price will be taxed, but in 19-20 that rises up to 19%. But strangely, it drops back to 2% the year after. So again, some planning opportunities there. I mean, it's time to look at that Tesla. You'll see the other bands increase quite significantly, but there is still the 37% cap right at the top level there. In 1920, there'll be a further 3% interest on most of those bands, and there's always been an additional 3% diesel supplement, but that's now going up to 4% because the government really doesn't want us to have diesel cars, except for if they meet this new real driving emissions step 2 standard, which are more green. One little perk that came out of this year was the exemption of a benefit in kind if an employer provides electricity charging points for your car. That will be an exempt benefit from April 2018, and perhaps a way that employers can incentivise again and encourage people to drive electric cars. Car fuel benefit is up. You have a car fuel benefit if you have any private fuel and you have a company car. That's up £800 to 23,400, and that same percentage is applied to that number to give you what you're actually taxed on. Vans, much more generous, and the figure is a lot lower, so it's a lot cheaper tax-wise to have a van or a twin cab pickle. You can see in comparison, those figures are much smaller, and again, they're the numbers that your tax rate, 20% or 40%, is applied to. National insurance for employees and employers remains unchanged in 2018-19, and you will note on there that if you're an employer, you take on someone under 21, you don't have to pay any national insurance, and if you take somebody on as an apprentice on a proper apprenticeship scheme, they're under 25, again you don't have to pay any national insurance, so you're saving that 13.8%. They are limited to about £900 a week, but that's a rather high salary. So moving on to capital taxes, we'll first look at CGT, which is capital gains tax. We've had an increase in the annual exemption for 2018-19 from 11,300 to 11,700, and that's the amount you can have in capital gain before you pay any capital gains tax. The rates went down a couple of years ago from 18% and 28% to just 10% and 20%, and there's different rates for different tax bands. So Rosemary was talking earlier about basic rate and higher rate. Any capital gain that falls into your remainder of your basic rate tax bands taxed at 10%, and anything else at 20%. That includes trusts, but it's not for residential property. We know that the government has really tried to discourage any tax breaks on residential property. This is one of them. So if you sell a second home or a student lets, then you'll still pay 18%, but more likely 28% on that capital gain. Entrepreneurs relief. Entrepreneurs relief is a relief from capital gains tax if you sell shares in a business. In this example here, we can see Bill owned 33% of the original share capital, and he wants to attract an investor to the business, but that will dilute him to below the 5% limit. Now, the 5% limit is very important because you can only get entrepreneurs relief if you own more than 5% of a business. So the government is going to look at this, intends to address the problem. So if Bill has got his funding and gone below that limit, he shouldn't have a reduction in his capital gains tax, or an increase rather, from the 10% to the 20%. Now, another change, again, against our residential property owning clients is the payment of capital gains tax. And capital gains tax is usually paid on the 31st of January following the year of assessment. What that can mean is that somebody selling a second home on the 7th of April 2017, that goes on their 5th of April 18 tax return, they don't pay any tax till the 31st of January 2019. So it can be quite a good planning point from a cash flow point of view. However, there's going to be a change. It has been put back a little bit, and it means that if you sell a residential property, there will be tax payable within 30 days of the sale, but they've now said that won't happen before 2020. Moving on to inheritance tax, IHT, the nil rate band remains frozen to 5th of April 2021. The nil rate band is £325,000, and it's the amount that you can have in your estate before you pay any inheritance tax, which is currently 40% of the balance over that 325,000. If you intend to leave your home to your children or grandchildren, then you may be entitled to an extra allowance. So that 325,000 you can see there that everybody gets can be extended to 425 in this year. It goes up next year until 2021. It's 500,000, and that actually gives a couple £1 million to pass to children. There can only be one residential property at that in the estate at that time that can be allowed, and there is also a tapered withdrawal if the estate is worth more than £2 million. What that actually means is that people with a business who might not necessarily be paying tax, inheritance tax, because of business property relief, might have that withdrawal. If that is withdrawn, then the allowable amount, the tax-free amount, drops back to the 325,000 or 650,000 for a couple. There are some downsizing rules. It is possible to downsize, so you don't need to stay in the larger house. That cash will be protected. You can move to a smaller house, which is the usual definition of downsizing, or you can have no home in the estate at all. So you might decide to rent or move in with family if they're amenable to that. There are lots of conditions, but you need a former qualifying residential interest. You need to have held a house at some point, a main residence at some point. This only came in on 8th of July 2015, so unfortunately if you downsize before that date, you won't benefit from from this additional allowance. And just to finish off with a few other matters, we're seeing more devolution. One of these, one of the devolved rules is in business rates. So Scotland, Northern Ireland and Wales are now able to set their own business rates. On top of that, England did a revaluation from April 2017, and we've seen many clients benefit from that because some are not paying any business rates at all now. The government's also supporting the businesses, as they say, because they're switching the indexation rules. So instead of using a retail profits index, they're using the consumer prices index for their increases, and that tends to mean it increases it to a lower level, not as quickly. They're also legislating retrospectively to address the staircase tax, which has affected some businesses with their communal areas and increasing their business rates. One of the main areas that was recorded in the newspapers was the reduction in stamp duty land tax for 80% of first-time buyers. For these buyers, if they're fortunate enough to be buying a house for £300,000, they'll pay no SDLT whatsoever. Then anywhere between 300 and 500,000, they'll pay 5%, which is the usual amount for that band. What this actually means is that for a £250,000 house purchase, they'll pay save £2,500, and it's double that for a £300,000. They'll save £5,000. There's a normal rules over 500,000. So anyone buying their first home over 500,000 does not receive this reduction. If a couple are buying and one's had a house before, then again they won't benefit from this. Some minor changes. We know from when we were looking at the budget a year ago, there was an extra 3% added in stamp duty land tax to anyone buying a second home, and there was a lot of different types of transaction that fell within that definition, and the wrong people were getting taxed on that extra 3%. And just on there we've written a list of the people who are now not going to have to suffer that 3%. It's been catching some of the wrong people. More devolution, this time stamp duty land tax. We've had a land transaction tax in Scotland for a little while now. That's also going to be introduced in Wales from 1st of April 2018. So if you are buying or have clients buying properties in Scotland or Wales, they won't necessarily pay the same stamp duty land tax or land transaction tax as you might be expecting. And stamp duty land tax, there are going to be changes to the process for recording this with the revenue. The SDLT filing window will be reduced from 30 days to 14 days. So that's just going to give the solicitors dealing with these transactions 2 weeks to get that form in. But we are promised that there will be improvements to the stamp duty land tax return, and so they promise that it will be much easier. That comes in on 1st of March 2019. And as Rosemary said earlier, the VAT limits didn't change as we thought they were going to. The Office of Tax Simplification had suggested a significant reduction, and some figures mentioned were around £15,000, which was similar to some of our European neighbours, Germany in particular. The limits, however, have been frozen for 2 years and remain for registration at £85,000 and for deregistration at £83,000. The government have also said that they wish to look into the VAT fraud in the construction industry. So there's been occasions where along the supply chain VAT has somehow been lost and the government has lost out with this. So they will be looking at others in the chain to make good that missing VAT. They've given a while for companies to look into that, and they're looking at 1st of October 2019 before they plough forward with that one. vehicle excise duty, once again, diesel vehicles are seemingly going to be discouraged. So from 1st of April 2018, the vehicle excise duty in the first year will be increased. This will have an effect on a Ford Focus driver of £20 in the first year, but a Land Rover Discovery driver will find he has to find an extra £400 for that first year's duty. Trusts. The government would like to make trusts simpler, fairer and more transparent, and are ploughing ahead with a consultation in 2018 to try and do that. Moving on to compliance, HMRC, 155 million investment is going to put into finding additional resources and technology, and that's expected to recoup 2.3 billion in taxes for the government, which sounds like a good investment, but we'll see how that one pans out. And just to finish off with some rates and allowances, we've got capital allowances. This is in particular for cars and might just be a planning point if you are thinking about buying cars for your business. The emissions at which you get a more favourable rate of 18% are 110 grams per kilometre, and that's being reduced from 130 grams per kilometre from 1st of April 2018. So it can be worth buying that car a little bit earlier if it's somewhere between 110 and 130 grams per kilometre of carbon dioxide emissions. Similarly, for even more efficient cars, the 100% first year allowance, which means we can write off the whole of the value of the car in year one, goes down from 75 grams per kilometre to 50 grams per kilometre. And that's the end of the talk.
We'd like to thank you for attending, and if you would require any further information, please do visit our website www.cliveowen.com for further details, or contact us directly. Thank you very much.
Thank you.